somebody cook the fries, they can have a robot do it. And so that will unquestionably have an impact. Most companies, unfortunately, don't break it out. It's something that you can calculate if you go to their financial statements. Generally, it's just broken out as those two line items. You just add those up and then compare that to the revenue of the company, and that can give you the margin for that.
Last thoughts, if somebody's interested in buying a restaurant stock, any final words of advice?
Tread lightly. All right, folks, welcome to Investing for Beginners podcast. Today we have episode 377. And today we're going to do a little twisty turn here. So Andrew is actually going to interview me a little bit, and we're going to talk about restaurants and some of the things that you could look for if you're interested in investing in restaurants. They could be a very potentially lucrative space, and they are a little bit misunderstood. And so maybe I can help with some of my years of experience doing everything from washing dishes to managing a store. I can maybe spread some insight and be helpful to people on that kind of thing. So hopefully buckle in. It should be entertaining. Hopefully you'll learn a thing or two as well.
Awesome. Well, appreciate the willingness to share and the research you've done on this. And I'm excited to dive in. So if you look at the restaurant industry, just kind of big picture on a whole, is it a good place to look for investments? Do you see trends one way or the other when it comes to the restaurant industry today?
That's a great question. And I think there's probably kind of two different ways you can look at it. Number one is there are a lot of very large, very big brand name companies that their main business model is probably not growing real fast, but is very steady, very strong, and are reliable. And so if you're looking for companies that would be great dividend payers, or companies that buy back a lot of shares and are stable and reliable in your portfolio, then there are some great names out there in the restaurant space that would really fit the bill nicely for people that are looking for that. And if you're looking for, on the flip side of that, if you're looking for more innovative companies, maybe companies that are growing faster and that are experiencing a lot of growth, then there are opportunities out there as well in that space. So there can be a little bit of everything for everyone. Just kind of depends on how you want to play the different spaces.
Real quick, were there any like disaster stories? Obviously, don't have to throw anybody under the bus, but like things that you saw where you're like, oh man, somebody should never invest. Were there outward signals that make that clear?
Yeah, there's several things, but I think the first thing that you want to look at is just because they sell something that maybe tastes delicious doesn't mean that it's a great investment. And we've talked about this before. There are companies that sometimes they're great companies, but it doesn't mean that, like they make a great product, but it doesn't mean that that's a profitable product. And long run, that's really what you want to see. And I'll throw Sweetgreens under the bus at the moment. This is the company that I hadn't done much work on at all, frankly, but I came across somebody who did on Twitter a while back, and they discovered, and this is like restaurant 101. I don't know how they've gotten where they are by kind of ignoring this, but their, I guess, item economics are terrible. And by that, I mean, the main thing that you sell, you should make money from it. Kind of whatever, doesn't matter whether it's an iPhone or whether it's a hamburger. If you can't make money from that, you're going to have a lot of problems. And a company like Chipotle, which was unprofitable for a while and now is very profitable. A company like Cava, who's sort of in the same industry, but kind of not. They are unprofitable, but they are on a path to being profitable at some point. You can argue about the whole valuation thing till the cows come home, but you can't dispute that they're on the path to being a profitable business based on what they do and how they do it. Sweetgreen, on the other hand, for every salad that they make, which is that's the thing they sell, for every salad, they're losing money. And that you may go, whatever. But if you can't make money on the thing that you sell, and that's your only thing that you sell, you're in trouble. That does not bode well in the future. And how they got public doing that is shocking to me. As somebody who's worked in the business for a long time, I don't get that. You can call me an old fuddy-duddy if you want.
Yeah.
I'm okay with that. But as an old restaurant person, if I can't make money on the main thing I'm selling, then it leads me to ask questions. You aren't controlling costs. You have no idea how to price what you are selling, and you haven't figured out a market to sell it to. And personally, never eaten there. I've heard that the salads are fantastic, but at 20 some bucks a salad or whatever they're selling, that's a lot of money for a salad. No offense, but it's lettuce. And, I guess I have a stigma or a bias against lettuce after working in a restaurant business. It's, was never a sexy, exciting thing. I'm sure Sweetgreen is far more advanced than what I'm thinking of. But I guess my point is that when you see something like that, when you're kind of investigating a company, whether, again, it could be anybody, but in particular in restaurants, if you find out that they're not making money on their main item, yeah, that's not a good place to be.
Yeah, that's crazy. So is it like a gross margin is negative kind of situation?
No,
Or-
the gross margin is still profitable, but everything else is like wildly negative.
Okay.
And they keep raising the prices and it doesn't get better. And so that to me is like, they haven't figured out how to make their main product profitable, and then everything else is just cascading from there because, they haven't figured out the leverage of like, what can I sell it for and how can I control my other costs to make that profitable. And yeah, that's a really, really hard place to be.
I don't know why people eat salad, period. So the things you're telling me just going over my head. Just kidding. But yeah, I don't like salad that much. Okay. So what are some good signals like KPIs, or like what would be the first sign where you look at just a restaurant business and be like, oh, this thing probably has good growth potential?
Well, there's two things that as an operator and as an investor you want to see. Is number one is growth in units and year over year growth in units. In other words, are they building new stores and are they continuing to build new stores? Because that's the path to growth in the restaurant business. And number two is revenue growth. And that's generally same store revenue growth. Overall revenue growth is, all fine and dandy, but what you really want to see is, did a restaurant that is operating in Raleigh, is it growing its sales year over year in Raleigh? And if it's not, then you need to figure out why. And that's really what you want to see is not only number of stores growing, but then also the organic growth in the market that they've already established. Because if the company is putting the stores in bad markets or bad locations and they're not growing year over year, that's a sign that there could be trouble in the future.
So maybe they've overextended, or they're just bad at, like, they're just taking growth without considering ROI.
Yes. Yeah. That's not, short term, sure, that could be great. But if you want to own this company for 10, 15, 20 years or longer, then you want to see those things.
Do you look at same store sales? Obviously that's a retail term, but they use it in restaurants too.
They do.
Do you look at that as like a pricing power thing? Obviously part of it's the location, like you just mentioned, but do you also look at it as pricing power, or do you think it's more something else?
I think it's a combination of two things. Number one, it is pricing power. And number two, it's the desirability of what it is they sell. So they've been able to find a product market fit with what they're selling. You can argue about the healthiness or not healthiness of McDonald's, but you can't argue that they have figured out what people want, and they've been able to put it in places where people want to get it for a very long time. And Chipotle has done the exact same thing. And it looks like Cava is doing the exact same thing by putting their stores right across the street from Chipotle's, which is, brilliant, but that's what you want to see.
Yeah, totally makes sense. Are there other KPIs that stand out to you?
Yeah, there's three other ones. So if you're kind of looking at the income statement, that's really important for restaurants. So we talked about like year over year growth in units, in same store sales, and overall revenue growth, but you also want to look at gross margins, operating margins, and something that we in the industry call FNL, or food and labor. And so you want to look at those three in conjunction. And the reason why you want to look for these is gross margins tells you how profitable the company is selling their main product or main products, whether it's a Chick-fil-A or whether it's McDonald's, a Chipotle, Texas Roadhouse. You want to see those margins nice, fat, and happy. Better those are, that tells you two things. Number one, that they have control over their main costs, which are going to be, in this case, is going to be food. And it's also going to be in the operations of the business. And that would lead you to labor. And so those two things are the two biggest costs that any restaurant has, is buying the food and controlling those costs. So the gross margin tells you how well they price what they're buying. So if you look at Texas Roadhouse, for example, they sell steaks. So how well they control buying those steaks and the margin that they can generate by selling those steaks at a price point that their customers want and feel like they're getting value, and allows the company to be profitable so that they can continue to invest, i.e. open new stores. And so if those things aren't being controlled, then either something's gotten out of whack or management just doesn't have a handle on their costs, and that will eventually be the death of the business. And then I guess the operating margin really kind of feeds into more about the labor, because again, that's the second biggest cost in a company. And so the larger the operating margins are, the more profitable a business is going to be. And that may sound like a duh, but when you think about going to Texas Roadhouse, you see the hosts, you see the bartenders, you see the servers. Those are all the front of the house staff. And then you have all the people in the kitchen, people washing dishes, very important. Probably arguably the most important position in the kitchen is the dishwashers, and they're generally the lowest paid. You also have all the people on the line, people, doing grill cooks, saute prep, the expediters, all kitchen managers, all those people are all part of the payroll, and you have to control those costs as well. And with the market now demanding that employees get paid more, when McDonald's, it all filters back. When McDonald's pays their hourly people $16 to $20 an hour, that filters back into a fast casual or more of a sit down restaurant like Texas Roadhouse, because now for them to get qualified good people to work in the kitchen, for example, they need to pay that or more to compete, because there's zero reason why somebody would suffer in a kitchen and work at Texas Roadhouse for $12 an hour when they can go work at McDonald's for $20. And so when those costs go up, and they should, the people need to be paid what they're worth, and you can't argue about that. But that has a direct bearing on the profitability of the company. And so if a company doesn't have pricing power and they have to raise prices for wages, that's what you're seeing in McDonald's right now, because McDonald's is paying across the board. They're paying their people more. The prices of what we pay as customers has gone up. And that's all to maintain the same kind of margins that the company operates in. And so something like food and labor, most companies unfortunately don't break it out for you as a metric. So it's something that you can calculate. If you go to their financial statements, you will see the food cost. You also see the labor cost. And generally it's just broken out as those two line items. You just add those up and then compare that to the revenue of the company, and that can give you the margin for that. So it's pretty easy.
Awesome. Are there tried and true ways or like playbooks for managing that, what you call F&L, or these food and labor costs? Are there ways to get more out of the labor other than just being like a fiery tyrant?
A slave driver?
Right.
Yeah, there's some, there are some tricks that you can use. There's two of the main ones that I saw when I was working in the industry was, number one was learning how to schedule correctly. And that means that you have the people you need when the business requires it. So for example, let's say that I'll just use easy numbers. Let's say you have 20 servers on staff. On a Monday or Tuesday night when it's really slow, you don't need all 20 people there to service the lower volume of business that you probably will have. But on a Friday and Saturday night, when you're going to be, marketably busier, you need more of those people on there. But you don't need all 20 of them on at the same time. And so you would stagger people coming in and coming out, so you can kind of try to control those costs. The other ways you can do it is you can try to configure your kitchens or your restaurants in a way that the people have to move less and makes it easier for them to do their jobs, which makes them more efficient, which means that you can have less people doing those jobs because the people you have doing them are more efficient and you don't need as many bodies. And so when you start doing those little tweaks of things, that kind of stuff can really help make a restaurant more profitable. And if you look at a company like McDonald's and Chipotle, these are very good examples. McDonald's has figured out to an art of how exactly to make all their food and have the right people at the right place to execute on what they need to do to make the food at the quality that is expected for a McDonald's. And so they've developed systems and processes that allow them to do all those things as efficiently as they possibly can. And Chipotle has done the exact same thing. They've figured out a way to develop PARs and when I say PARs, that means level of food or prep that you make based on how much volume you expect to do at 12 o'clock to 2 o'clock on Wednesday. We're gonna make these many chicken breasts because we expect to do this much volume in this period. And so then I need one guy one person to do this and one person to do all the prep work. And so you just figure out how to schedule all those things, and all that stuff allows you to control your costs as best you can.
Yeah, makes sense. So that's awesome. There's two types of models. So you mentioned Chipotle and McDonald's, one of them being the franchise model, the other one corporate owned.
Mm-hmm.
Can you break that down and talk about some of the puts and takes, some of the differences and how some of that feeds into the operations?
Yeah. So when you're looking at restaurants, there's kind of two main types, if you will. There's the corporate model and there's a franchise model. So the corporate model, basically what that means is that every store in the business is owned by the corporation. They don't sell them to outside people or other people. And the restaurants, by and large, are run by the overall company. It's no different than Walmart or an Amazon store, or think of Lululemon. They're all corporate stores, and those stores make the vast majority of their income from the operations of the business. And so they have a direct control over the operations of the business, the cost and the building of the stores, and all the good and bad. Chipotle's corporate is responsible for all of it. Texas Roadhouse is responsible for all of it. And so that's kind of those kinds of models. And then you have the franchise models, which can be a combo, often is a combo of that. So McDonald's has franchise stores, and then they also have corporate stores. And so the franchise stores, the way that those work is the franchisee, the person that they give the franchise to, they are, depending on the contract or how they work out the deal, the franchisee, the person who buys the McDonald's, is responsible for the store, building the store, the operations of the store, buying all the food, pricing, marketing, all those things. McDonald's just gives them basically the menu and the brand and the operations manual for them to operate a McDonald's. But the profitability or generation of the profits is all on the franchisee. And for that right, then the franchisee gives McDonald's a percentage either of their revenue or their income, their profits, as a franchise fee. And so when you look at McDonald's financials, for example, you'll see basically two line items for the revenue. One is for franchisees or franchise fees, and the other one is for the corporate stores and the operations that those McDonald's generate. And so when you're analyzing these companies, you have to look at them differently, because you look at McDonald's and go, wow, they got great margins. compared to a Chipotle? Well, no, it's not, because that, if you're just looking at gross margins, it includes franchise fees and operations of the business, and that's not apples to apples. And so that's the main thing. So companies like Domino's, QSR, McDonald's, there's lots of them out there. Yum Brands. Those are all companies that own collections of different businesses, and they sell the franchise models to individuals or groups of people that will go out and want to hey, it'd be fun to own a restaurant, and so they go out and buy a restaurant. It's not fun.
I find it interesting though, like, when you think of a mom and pop restaurant, you never think of like a franchise owner, but like they are kind of mom and pop in a way.
Oh, yeah.
I mean, they're just regular people.
Right. Yeah. Like, Chick-fil-A is a great example of a franchise model. And I don't know all the ins and outs of it, but I've read tidbits, and it's like you have to work at a store for a certain amount of time before you're eligible to buy a franchise. And then you have to plunk down a good chunk of change. And then you have to work in the restaurant for the entire time you own it. You have to operate the store as a general manager. So, and you're only allowed to own, I believe it's 2 of them. So it's not one of the, like Yum Brands, for example, is kind of famous for, do they own McDonald's? Or I'm sorry, Burger King, or is it Pizza Hut? I can't remember. I blank on
Pizza
that.
Hut.
Pizza Hut. Okay.
Yeah.
So there are franchise owners that own hundreds of Pizza Huts, but QSR is still the owner of the whole corporation. Or Yum Brands, I'm sorry, is still the owner of the whole operation. So those aren't like mom and pop, but Chick-fil-A would definitely be more of a mom and pop, because they own 1 or 2 stores and that's it. And they're doing all the heavy lifting for Chick-fil-A.
Yeah, that's a good point.
Mm.
Has there been like a noticeable difference? You've worked in both environments, right?
Mm-hmm.
Is it just like it depends, like every single restaurant's different, or are there like noticeable differences between, you can tell like from the inside, ooh, this feels franchisee, or ooh, this feels company owned or corporate?
In my experience, it depended on the leadership, frankly. Some leaders, general manager, maybe if you have area directors or things like that, were way more by the book, and they wanted their store to operate exactly like the other stores operated in the company. And then other ones, on either side, whether it was a franchise model or corporate model, were a little more relaxed, is probably the best way of putting it. The food was always the same, the way the food was always prepared, but the decor of the stores, the attitude of the employees can be different. And so it really kind of came down to really what the leader wanted for their particular store.
So it's a mixed bag.
Yeah, very much so.
Okay. Is there a preference as an investor to the franchise model or the corporate model in your book?
Yeah, that's a great question. I think there's strengths and weaknesses to both. I probably lean more towards the franchise model, simply because I think it's probably easier to scale a franchise model once you figure out the model. And number 2, it's more profitable. I mean, just across the board, they just generate more profits. It's, if you look at the profitability, well, maybe this is the best case. I was going to say Costco and Kroger, but that's maybe not the best example. But by and large, if you look at the franchise model, they're more profitable than the corporate stores are. But there are lots of great corporate stores out there that have really figured out their niche and are really good at what they do. And Chipotle and Texas Roadhouse, to me, are 2 that stand out in that respect.
Yeah. Well, the ROIC for Domino's is, if you calculate the way we do, it's
ridiculous,
80%, something crazy. Yeah.
Yeah, it's nuts.
Talk about that scalability for a bit, if you would. How important is that if you're investing in a restaurant stock? How do you assess the different levels of potential scalability?
Yeah, it to me, it's probably, if you want continued growth in your company, if the restaurant can't scale, it's going to have a limited shelf life. There's 2 examples, Chipotle and Noodles and Company. So Chipotle is what you would consider fast casual. Noodles and Company is also considered fast casual. And what that means is that you get the food fairly quickly but it's in a more relaxed atmosphere than a sit down restaurant would be, like a Texas Roadhouse or, a Fridays or a Chili's or, Cheesecake Factory kind of thing. Those are a little more formal. You sit down, the server comes and waits on you and so on. So a company like Chipotle has been able to figure out how to create their food in a way that is quick, delicious, and efficient, and they can replicate it in a lot of different locations. So because they were able to figure out what their menu was and make it simple enough that they can execute it on fast and quick and make it taste good, that allows them to just scale up and put them literally anywhere, because you don't need a lot of special people to be able to make it and do all the different things. And so, they're very conscious of how fast people go through the line. That's one of the internal KPIs that they measure on a store level, is how quickly they turn people through their system. And they train their staff and work really hard to make that fast, because they understand that that's uber important. Noodles and Company is kind of the flip side of that. So it's a fast casual restaurant, but if you ever go to one, you notice this is why they're having a hard time scaling up. It takes too long. When you compare it to Chipotle, Noodles and Company doesn't have the noodles ready for you when you walk into the store. So when you go and order, let's say fettuccine Alfredo, and you go and order it at Noodles Company, they make it for you fresh then. So there's not somebody in the kitchen putting noodles down in the water until you order it. Right. And that automatically is going to take 8 to 10 minutes to cook. And that's 4 or 5 minutes too long. And people don't want to wait for that. They just don't. And that's what makes it hard for a company like Noodles and Company to scale up at the same level that something like a Chipotle. And that's what that Cava has replicated what Chipotle is doing. And that's what's allowing them to scale up so fast, is because they have a market, they have a niche, and they are pushing the envelope on that, where Noodles and Company hasn't figured out operationally how to make it so that they can get noodles into somebody's hands, without a server in 3 to 4 minutes. And because they don't have that, it just takes too long.
Yeah. Are they public?
I'm not sure if they are or not, to be honest with you.
Okay. Yeah, I don't know either. I'm not a fan.
No, me either.
But that's besides the point.
Right.
Sorry, I didn't mean to throw you guys under the bus if you like that. What about, how does real estate play a role? How important is locations in real estate?
Well, I mean, in the restaurant business, is all about location, location, location. I can't speak for the rest of the world, but in the United States, it's uber critical. How many of us in our local area have a restaurant that you will go to because it's in a location you want, and it fits where you're trying to go? A lot of the value that's tied up in McDonald's right now is real estate. They're as much a real estate company as they are a restaurant company, because they own all the real estate that the stores are on. And so that makes it incredibly valuable, because almost all of the McDonald's are in prime, valuable real estate locations, which gives the company a lot of value. I know you're a big fan of California hamburger, In-N-Out Burger. In-N-Out Burger.
Yeah.
Part of the value for In-N-Out Burgers is where they're located. Oh, yeah. And that also goes to the profitability of the business too. Because if you overpay for the land, if you put it in, prime A1 locations, and you're paying, prime A1 rents for the real estate, that's another hurdle the store has to get over, or the company has to get over for profitability. And so it needs to be relative. And so it needs to be an easily accessible place, and it needs to be invaluable real estate, which can be part of the value of the business. How many times have you been to a restaurant or considered going to one, but it's a pain in the ass to get to? It's like you don't go there very much because it's hard.
Yeah.
So
makes sense. And not even just being in a high traffic area and having that visual reminder, that does wonders. to
Yes,
me.
it
I mean,
does.
I'm a pretty easy sell though. I love
Right.
I love junk food. Why? Cool. That's awesome. Do you think there's a maturation point for like, and I'm thinking about Domino's Pizza. They talk about the whole fortressing idea.
Mm.
Do you buy that, or do you feel like that the maturation is something that all restaurant companies have to face?
I think there's a couple things you want to consider. Number one, the flavor profile or the tastes of the customers, they evolve, they change. And that's why you see restaurants constantly trying to tinker with their menus or adding things and taking them off or putting them on there for special seasons. McDonald's with their McRib, for example. Whether you love it or hate it, it's obviously got some popularity, and that's why they keep bringing it back. But it's not a permanent part of their menu. And if you think about a restaurant like McDonald's, part of why they can't grow as fast as Chipotle is because the tastes of the United States have kind of changed and shifted a little bit. And so at some point, every restaurant faces that. If you look at some of the older ones from that were really popular when I was a kid and now are not as popular, Fridays, Applebee's, Ruby Tuesdays, those companies when I was a kid in the 80s were the it stores. And now they're, usually in anchor malls that are mostly empty. And so they just aren't as popular as they used to be. And that's just kind of the nature of the biz.
So does that lead you to say that it's very rare, if not impossible, for a restaurant stock to be a buy and hold for life?
Depending on the company, I think you're going to see a faster evolution through the cycle of business life than you may see for a company that is in a longer churn cycle. Like if you compare the churn cycle of a Chipotle to a Google, Google will probably be, I think Chipotle will mature faster than a Google will.
Because of the customer taste thing, or
because of the customer taste thing, and just it will stop at some point. It will stop being the cool new place to go, and it'll start to become, the place that mom and dad like to go to, but not the kids, right? And then once that turns, then the kids are going to find Cava instead of Chipotle, and then 20 years from then, when those kids have kids, they won't want to go to Cava, because that's where mom and dad want to go. They won't want to go someplace else. And so that's just kind of the nature of the restaurant business, is that the average, so throw out some numbers at you. The average restaurant only lasts, I think it's 2 to 3 years, and most restaurants close. 96% of all restaurants close within the first year of opening.
That's tragic.
So the success rate of restaurants is staggeringly horrible, statistically quite bad. And for a restaurant for just a location, like a Chipotle, to last for 20 years in the same location and still be, best of breed kind of thing, is rare. And so there's just a natural evolution. What's a brand new location in 20 years may be, the population around it has gotten older too. The young people have moved out, the older people have moved in, people with families, maybe that's not a family style restaurant. And so all those things change over time. And then that just means that store location becomes less and less profitable, doesn't grow as much. And that's just kind of the nature of the business.
You're making me think of my old hometown Arby's.
Right?
Special place in my heart.
Yeah.
I hope it's still open. All right. Last thing. There's technology in every industry. Are there any technological advancements that are interesting that are going on now? And do they have any effect on these businesses?
Yeah. There's kind of two main things. One is robotics. There has been an increase in interest in building robots that can replace employees in places like a McDonald's or an Arby's or, Wendy's or those kinds of things. They, instead of having somebody cook the fries, they could have a robot do it. They could have a robot make all the hamburgers. I don't think that's probably that far away from being a bigger thing. And so that will unquestionably have an impact on, in particular, fast food restaurants. I think will have a bigger impact. I'm not sure. I guess to me, the jury's still out on whether a Texas Roadhouse is going to have four robots in the kitchen cooking all the food. I'm not saying it won't happen, but I think that's maybe a little bit farther down the road. Kind of associated with that is like the automated ordering. Like if you go to McDonald's now, you don't order at the counter. You go to the little kiosk and you order all the food and they do all that stuff. I think that's going to become more and more prevalent. AI is starting to take orders when you go through drive-throughs. I haven't personally witnessed it, but I've read about it where they're utilizing AI to take your order when you go through a drive-through at Wendy's, for example. And I could see that becoming a thing quite easily. And then there's also, of course, the apps, the Chipotle app, the McDonald's app, and so on, where you can order online. And then when you pull into the store, you tell them your code, and then they have the food ready for you. And I think that stuff is going to become a bigger and bigger part of how, especially the younger generation, maybe not me, the 58-year-old dude, may not embrace that as much, but our kids, you and I's kids, that's how they'll probably order the majority of their food. And all those things are coming, and it's all kind of it will certainly impact the financials of companies because they won't have that big labor cost that they have because they're replacing some of these with the labor. But the flip side of that is that they'll have more R&D, or they'll have more CapEx costs than they may have had in the past because they have to either maintain the robots or the AIs and the systems that they have. So they may have other costs associated with that. And that could just wash, it could just even out. I think at some point it will probably start to become some operating leverage and give them a little more profitability, but I don't anticipate it being a huge difference, but I could be wrong.
That's a bummer. It sounds like a lot of potential.
Oh yeah.
But to your point, I think the technology would have to get a lot cheaper. Like we'd have to see prices drop like we saw for computing or something like that. Because I bet they're still very expensive.
Yeah. Right. Yeah. The first mover that starts putting robots in their stores to do basic cooking tasks will be a novelty, and it'll be super exciting, and people will be like, wow, that's awesome. But it's also going to cost those restaurants an arm and a leg to do that. And other than the novelty of it, like to your point, until they can reduce the costs, it won't really impact the financials much for a Domino's to have, four robots making all the pizzas.
I have seen a couple of those robots. They'll bring you their food and they wheel it over to you.
Yeah.
Interesting concept.
Yeah. Yeah, it really is. Yeah. But to your point, I think we're still way early innings on all that.
Yeah. Any last thoughts if somebody's interested in buying a restaurant stock? Any final words of advice?
Tread lightly. The restaurants they can, like I said at the beginning, they could be potentially great investments. But I think if you kind of follow what we talked about today, I think that can help you go a long ways towards really understanding what's driving the profitability of the businesses. And then the other thing is, I think you really need to think very hard and very long about what the moat or continued excellent in the performance of the food as well as the operations of the business, like how likely is that going to happen? And try to determine what you think, like where are they in a business cycle and how long do you think they still have? Because that definitely has a bearing on what you should expect from the investment that you make.
That's awesome. Yeah, a lot of good information, a lot of things I feel like you won't hear when people are pitching those restaurant stocks. They don't talk about what you said, but that is a harsh reality. It is a very hard business. And like you said, it does change. So we appreciate all of those thoughts and insights. That's going to wrap us up for today. If you have any questions for future shows, please reach out. You can find us on Twitter. Dave's at IFB_podcast. I'm at Value Spotlight. Take action today. Connect, learn, and grow with Value Spotlight. Peace.